of the concept of interest and the concept of amortization of discounts and premiums on bonds. So let's look at, let me share my screen first. Okay, so I'm going to go back to Blackboard and I will access McGraw-Hill Connect. I find these questions in the in-class practice set very helpful. So let's look at this from your perspective, from your view. So last time we talked about bonds as a form of debt financing. So when we issue bonds, remember we're always the accountants on behalf of the company. When we issue bonds, we need to know that the only reason why we're doing that is to obtain financing or to obtain cash. So last time we went over bonds that are issued at par, which basically means that the company will get exactly as much as the par value of the bond is. Then we talked about bonds issued at a discount and bonds issued at premium. So whenever the company issues a bond at a discount, you guys need to know that the cash collected by the company will be less. Whenever the bond is issued at a premium, then the cash collected by the company is more because the market perceives their bonds as a good investment. Bondholders have to be rewarded. So one of the calculations we looked at last time was the calculation for semi-annual interest. Most companies pay semi-annual interest. There are some bonds that pay annual interest, but that will be specified in the question. So last time we walked over all the accounting issues, what happens when the bonds are issued, what happens when interest is paid, and what happens when bonds are retired. So you will find this chapter quite challenging. And then on Sunday, you also have your test assessment, or I always struggle with calling it a test because I give you multiple attempts and they're really long. So this is another one of your assessments, really. But you might find that challenging as well because in addition to bonds, you also have a few other hefty chapters. So we'll talk about that in a few minutes. So let's look at some of the problems in the practice set. So let's look at the first one. In this case, the company plans to issue bonds. They're 8% bonds. So last time I showed you that this information appears on the bond certificate. So they're 8% bonds, and the value of those bonds is $4 million. If the company sells $3,600,000 of the bonds at par on January 1st, they sell the remaining on July 1st. So we need to calculate what is the interest paid by the company on June 30th and December 31st. So I want to always look at the timing of events. The first 3.6 million, this information right here, is issued on January 1st. So the very first interest payment, which is on June 30th, will only be for the 3.6 million bond. Once we add the remainder, 400,000 on July 1st, then the second interest payment will be for the full $4 million amount. So the first thing we're going to have to do is we need to calculate the interest and then prepare the journal entry. We know that the journal entry will always be interest expense and cash, because bondholders like to be paid in cash. Now the question is, what is the amount? For the first payment, we'll take the value of $3.6 million and we'll multiply it by 8%. I personally like using Excel as my calculator. So here's the 360000. I can do whatever I want here in Excel. I can format it so I can see the decimal point or not. So in this case, I have 3.6 million and 8% interest rate. And just in case you're wondering, my whiteboard is not working no matter what DCC did with my computer. So the very first interest payment will be $288,000. Do you guys think that's a correct statement? I don't think so, right? Because this is an annual percentage rate. So when I calculate this, it would be for 12 months. So I need to take 288,000 and divide it by 2. The 144,000 would be my interest expense for the first semi-annual interest payment. Okay, so this is what happens on June 30th. So I'm going to record the journal entry on the next interest payment date, December 31st. Remember the company. Come on, anyway, so remember the company has to now account for both the 3.6 million of the bond and the remaining 400,000. There's 8% bonds. I'll just replace this with 4 million. And I can see that now my next interest payment will be $160,000. So the first interest payment on June 30th will be the $144. And then on July 1st, we'll pay the additional interest. The question here, though, is how do we record the sale of the additional bonds? Remember what we saw earlier, the company issues bonds to collect cash. So every time we have a bond issuance, cash will go up and bonds payable will increase as well. Here, $400,000 will be, I keep saying 400 and type 4 million, $400,000 will be the additional issuance of the bond. Now I'm missing a zero. Okay. So here's my second journal entry. So I showed you how to figure out the first interest payment, which is only on the first amount. And then on December 31st, I showed you how to calculate that interest payment for both of the stock issuances and how to record the sale of the bond. Now, again, here, this bond is sold at par. So whatever the par value of the bond, the company will receive the same amount. So this is just an introductory problem. So let's see what happens when the company issues bonds at a discount or at a premium. All right, here we go. So in this case, the company issues 8%. This is the stated interest rate, 10-year bonds. The par value is $250,000. On issue day, the market rate is 10%. Now that's a problem because the bond offers the investors 2% less than what the market offers them. And as you know, investors have finite, limited resources. If they have to pick whether to choose the bond that this company offers at 8% or to choose the market investment at 10%, investors would prefer the investment that gives them a higher rate of return. So in order for the company to make their bonds valuable to investors, they need to offer some incentive. And the incentive offered is this lower price at the time the bond is issued. So in this case here, we know that this is a discount bond because we compared the stated interest rate to the market interest rate. We can see that the bond offers a lower reward to investors than the market. The selling price is 87.5. This immediately tells you that the company is not going to be getting cash of $250,000. This is a discount bond. I can go ahead and plug in the journal entry immediately. I know that discount or not, the company is getting cash. I know that this is a discount bond, so I'll be looking for the discount on bonds payable account, which last time I called a contra liability account, and I will be crediting bonds payable. So bonds payable will be for the full amount of $250,000. Again, I'm missing a zero here, so let me add one. So bonds payable will be for $250,000 because of maturity. The company will have to pay that amount back to the bondholders. Well, let's see how to calculate the rest. If the par value is $250,000, right? And the selling price is 87.5. I think this is a percent. So really what the company will be getting is 7.5% of the face value or the par value of the bond. I know that this here will be the cash because by doing that, by issuing a bond at a discount, the company gives the investors an incentive to let the company borrow a little less today and collect the full amount later at the maturity date, at the maturity of the bond. So if I take the 250,000 and subtract the cash, this should be my discount on bonds payable. So 218,750 and a discount of 31,250 will be debited in this journal entry. So this is how we record a discounted bond or a bond issued at a discount. All right, so let's look at a bond at a premium and then amortize some premiums. The next problem, this is again a bond at a discount. So we're not going to work on that. This is very similar. We are going to skip and we'll skip to 10-9, the bond issued at a discount. So again, my first job here would be to find the stated interest rate of the bond. Here's the 8%. And compare that to the market bond. Here's the market right here. The bond offers investors 8% return on investment, while the market offers investors 5% return on investment. This tells me that the bond will most likely be perceived as a better, more valuable investment by bondholders. So this bond will be issued at a premium. I can see that here, the selling price is 123.375. So this bond will be selling at 123% over the face value of the bond. So here's my calculations. I have the same $250,000. The selling price is 123.375. I'm thinking of this as a percentage. So whenever the company issues a bond at a premium, the cash proceeds will be higher than the face value of the bond. So I'm expecting the cash proceeds to be higher than $250,000. And as you guys can see, cash is 308. The difference between bonds payable and the cash proceeds is what, oops, the other way. The difference between the cash proceeds and bonds payable is what we call premium. Do you guys have any questions? Does this all make sense?
Yes, it does.
Okay, perfect. So like I said, the reason why we're doing this is because I find it a little more challenging, and I want you guys to not have to struggle when you're working on the homework. So here, for this problem, all I have to do is just type my cash proceeds of 308,437, and then the rest is, you know, just understanding the timing of events. All right, so let's so we looked at a bond issued at par, a bond issued at a discount, and a bond issued at a premium. So now we need to look at how do we pay interest, and what do we do with the premium or the discount? So both of those things, the discount on bonds and the premium on bonds payable, they have to be amortized. So last time we said that they have to be amortized by using the straight line amortization. So in this case, we have a bond. They issue a 5-year bond on January 1st. Hold on, I think I have a question. Sorry, maybe I have 2 questions. All right, so Jacob, I'm so sorry, I didn't see your question earlier. So Jacob's question is, so because 308 is higher, yes, it is a premium, but also, if you remember here, let me show you my Excel spreadsheet. I actually calculated it. I know that this is the par value. This right here, see how the price 123.38 is much higher than 100%. This right here will tell me that this is a bond sold at a premium. But you're also correct, because the cash proceeds are higher than the face value. That makes the bond sold at a premium as well. So I'm sorry I didn't see your question. And then Dave has a question. Whenever it sells higher than the par value, it sells at a premium. That's exactly right. So I think, Dave, you were answering Jacob's question. Or I hope that's what you're doing. Okay, so let's look at this one. This one here has, yes, you are correct, Dave. All right, so this is, as I mentioned, this company issues the bond on January 1st. It's a par value $200,000 bond. The unamortized period, premium is $16,222,000. So at the time of issuance, we know, this is what we know. I'm going to scroll down a little bit. I'll still use Excel as my calculator here, and that way you guys can see what I'm doing. We know that the par value of this bond is $200,000. Okay. We also know that there is a premium, and the premium at issuance is $16,222. That tells me that the carrying value of the bond is the sum of the two. On the financial statements, the company will report both of these things, the par and the premium together. So this is at the issuance. Remember that the company pays interest semi-annually. We're specifically told that. So we need to record a couple of things. We need to record the issuance first, which is pretty simple, right? When the company issues a bond at a premium, they get cash. They also have to record bonds payable, and they have to record premium. On bonds payable. So bonds payable and premium on bonds payable will be credited. So in this case, I'm taking the data from up here, right? The bond payable is $200,000. So here is my credit, $200,000. At the same time, I can see that the unamortized premium is $16,222. 222. So that tells me that the cash proceeds, just like we talked about it earlier, would be $216,222. And I'm recording this journal entry because I think that's correct. All right, so the first interest payment. So the first interest payment I have to calculate. I know that the company will pay 10% interest. So the first interest payment will be calculated based on the $200,000 par value and the 10% interest rate. I know that if I take 200,000 and multiply it by 10%, this will give me the annual interest. I know that if I take this and divide by 2, this will give me the semi-annual interest. Okay. Is this the correct answer though? I don't think so, because remember we have to amortize premium. And when we amortize the premium, we need to use the straight line amortization. So this is a 5-year bond. We will be amortizing the premium based on 10 periods. So we have 5 years, but the company pays interest every 6 months. So I will multiply this by 2. So my useful life, so to speak, of this premium is 10 periods. There are 10 6-month periods. So the way we'll amortize the premium is we'll take the premium itself and divide it by the periods over which we'll be amortizing them. So every period will amortize 1/10 of the premium. So every time the company pays interest, now remember these numbers, they're paying $10,000 cash to their bondholders. So when we pay cash to the bondholders, we need to credit cash. In addition, we need to, I'm actually one line over here. So let's put cash over here on the very last line. So cash will be credited. When we're amortizing a liability account, we will debit that account. So we'll debit bond interest. Hold on. We'll debit bond interest expense. Where's bond interest expense? Okay, here is bond interest expense. And we will debit the premium on bonds payable. So cash would be the $10,000 the bondholders will be receiving. The bond interest expense would be the 1,622.2. I believe that's what the number was. And then the difference would be the okay, hold on. This is the amortization on bond payable 1,622.22. Okay, And then the difference between the two, which I can calculate here in my Excel spreadsheet, 10,000 minus 1,622, or 8,337.80 will be my bond interest expense. So whenever we amortize interest like that, we need to take into consideration that the company pays cash to their bondholders. That cash, though, is not the same as the interest because we also have to amortize the premium on bonds. Okay, let's see if I can find one with a discount. I don't see one with a discount, so let's go to your homework assignment real quick. So we will look at the chapter 10 homework assignment. And I'll find the problem that I'm interested in is the problem that has bond discount. And again, bond discounts are determined by the difference between, there's an amortized discount. Okay, so here's a bond which the company issues at a discount. And here is some of the information about that bond. They issue the bond at a par value of $200,000. We know that this is a discount bond because we are told so, right? We're not actually made to compare the 6% stated interest rate to a market rate. We are specifically told that this bond is issued at a discount. So the journal entry, if you guys look down here, the journal entry will always debit cash, but look at the amount of cash. See how the amount of cash is less than the bond payable? The reason for that is the fact that the bond is issued at a discount. So the difference will go in that contra liability account that we talked about last time, bonds discount on bonds payable. So earlier I showed you how to calculate the amortization on premiums. It works exactly the same way when you're amortizing a discount. So on June 30th, when the company actually pays interest, they have to credit cash only for that interest payment, which is $200,000 times 6%. That would be $1,200 divided by 2. I'm sorry, not $1,200, $12,000 divided by 2. That would be the $6,000 cash payment right here that they have to transmit to their bondholders. In addition to that, we need to amortize the discount. The discount happens to be $13,466. This is a 4-year bond. 4-year bonds make semi-annual payments, so the discount has to be amortized over 8 periods, 4 years times 2. So every period for the next 8 periods, when the company pays interest, they'll also have to amortize the discount on bonds payable, and this right here is the amount. You can see that the bond interest expense is a little less because in this case we don't have a premium, we have a discount, and when we have a discount, that increases our bond interest expense. So this is how you will be preparing the journal entries for recording the issuance of the bond and for all other interest-related transactions, including the actual interest payment and the amortization of bonds, discounts, and premiums. So let's look at another problem. This right here is another premium problem. This is number 3 on your homework. I just wanted to make sure that you're approaching this the right way. So the issue bonds, the par value is 400. In this case, though, we're given the market rates. The bond rate is 13% and the market rate is 12%. So that tells me that the bond is a better investment. This is a premium bond. I can also see that the bonds are sold for 409. So the difference between 400,000 and 409 will be the premium. The premium is $9,850. Do you guys have any questions about that? I really want to make sure you understand how to approach these problems. They're challenging, but I don't want you to struggle with them.
It's making a lot of sense.
Okay, thank you. All right, so anyway, so let's go to the next thing. How much total bond interest expense will be recognized over the life of these bonds? So over the life of the bonds, these bonds are, they mature in 3 years, so there'll be 6 interest payments. So every year, the company will pay their investors 13% on $400,000. Plus they have to amortize the premium. So when we are doing that, here is the 6 payments of interest, and then in addition to that, you can see the premium right here. They borrowed at a premium, they borrowed more, so the total interest expense will be the sum of these, the 556 total repaid minus the amount borrowed. So the interest expense will be the difference between the two. And then the last, this is a bond amortization table. You can see the unamortized account and how that disappears over the life of the bond. You guys are familiar with notes in mortgages that we talked about last time. So whenever they're borrowing on an installment note, you just have to calculate the interest just like we did back in chapter 3 for adjusting journal entries. And for mortgages, this is actually a perfect example for that. Mortgages are installment notes. And these are the journal entries here for notes payable. So I will take a few minutes. It's 1:40 right now. Do you guys have any questions on bonds at all?
No, ma'am.
Yes, I'm sorry, what did you say?
Oh, I said no, I didn't have any.
No, so you're good on bonds? Okay. So I will talk about the exam that you guys have to take on Sunday, just like all other exams. It's 2 attempts, 2 hours. The second attempt, you only have to work the questions that you missed during the first attempt. Exam 3 covers chapter 8, chapter 9, and chapter 10. So maybe fewer chapters, but they're all hefty chapters, except for current liabilities, which was pretty simple, I want to say. So I wanted to show you something. I don't have a formal review. However, if we go to, let's go back to Blackboard. In each chapter, as I've showed you before, so here is chapter 8, long-term assets. At the very bottom, there's sample exam questions. So here is what you guys need to know from chapter 8. From chapter 8, you need to be able to compute the acquisition cost of an asset, just like we talked about chapter 8 when we covered it. The acquisition cost is not just the purchase price of the asset, it's also taxes, real estate commissions. If it's equipment, it's the installation costs. So you need to be able to calculate that, and then you need to use, you need to be able to use the different depreciation methods. So you need to be able to record the asset purchase, and then you need to be able to record the asset usage over the useful life. And I really think that these problems here will help you get a feel for what the example is, for what the exam will be like. Gains and losses, how do we record those? We practice that I want to say in class always, but during the recorded lectures, during the live lectures, and then the purchase of the machine and the depreciation of the machine. So I said machine because the second and the third question focuses on machines, but you need to be able to assign a value, capitalize the cost on the balance sheet for any long-term tangible asset, and then depreciate it. So you need to know the differences between tangible and intangible assets, and the difference, how natural resources are different as well. So remember, tangible property, plant, equipment assets, they get depreciate. Intangibles get amortized, and natural resources get depleted. So I've given you here 10 questions to practice chapter 8. If we go to chapter 9, chapter 9 is current liabilities. I told you last week there's not a whole lot here, but I tried to give you some questions. If you look at these, it will ask you about short-term notes payable, as well as some payroll obligations, but there's really nothing difficult here. I can guarantee you on the exam, this chapter will be lightly represented. And then, of course, chapter 10, which is what we finished today. So for chapter 10, long-term liabilities, I've also given you some sample exam questions, which will help you calculate premiums and discounts. It will also help you with the multiple choice questions on discount and premium amortization and interest expense. So I hope this helps. 3 chapters is not a whole lot to be included on an exam, but like I mentioned earlier, 2 of those chapters, chapters 8 and 10, are pretty hefty. So if you guys have any questions between now and Sunday, please let me know. And as you know, I respond to email pretty quickly. You will get your answers immediately. Do you have any specific questions on anything that we've covered today?
Like, will there not be like an exam 3 review like you usually do, or do we just like use like samples to really review over everything?
The previous exams, the previous exam reviews, they contained a bunch of questions like that as well.
Okay, perfect. Thank you.
No problem. All right, well, good luck, guys, and let me know. Email me if you have any other questions. We're almost there. We have 1 more exam at the end of the semester, 3 more chapters to cover.